The European Central Bank, ECB, recently announced its decision to raise interest rates for the 10th consecutive time. This remarkable feat marks a pivotal juncture in the ECB's monetary policy under the leadership of President Christine Lagarde, signaling a potential shift in the trajectory of borrowing costs. Amidst a backdrop of heightened economic uncertainty, inflation concerns, and divergent views within the ECB's Governing Council, this decision has set the stage for a dynamic debate over the future of monetary policy in the Eurozone. In this comprehensive analysis, we delve into the intricacies of the ECB's latest interest rate hike, dissecting its implications, the economic context surrounding it, and the voices that shape this pivotal moment in European finance. The European Central Bank, ECB, has raised interest rates for the 10th consecutive time, marking a significant shift in monetary policy under President Christine Lagarde's leadership. This move has sparked discussions about whether this signals the peak of interest rate hikes. Although many economists and investors now believe that the 4% rate set on Thursday may represent the high point of borrowing costs in the current tightening cycle, President Lagarde refrained from confirming this assumption. She stated, "With today's decision, we have made sufficient contributions, under the current assessment, to returning inflation to target in a timely manner. The focus is probably going to move a bit more to the duration, but it is not to say because we can't say that now that we are at the peak." The euro currency experienced a decline of up to 0.7%, dropping to $1.0656, its weakest level since May. Bonds rallied as traders now perceive a roughly 20% chance of another rate hike, reflecting growing concerns about the region's economic growth prospects. Italian government bonds, which are highly sensitive to changes in interest rates, led the surge, with yields on 10-year bonds declining by 12 basis points to 4.32%, marking the most substantial drop in 3 weeks. President Lagarde noted that a solid majority of policymakers supported the decision, although she acknowledged that some colleagues would have preferred to pause the rate hikes. Prior to the meeting, officials recognized that this decision was the most finely balanced since the ECB began tightening its monetary policy in July 2022. The Governing Council reiterated its commitment to maintaining borrowing costs at sufficiently restrictive levels for as long as necessary, leaving the possibility of further rate hikes open if inflation proves to be more persistent than anticipated. However, Lagarde emphasized that the idea of reducing borrowing costs in the future was not even a topic of discussion. This decision places additional constraints on economic activity within the Eurozone, further impacting an already sluggish expansion. It suggests that policymakers are willing to endure additional economic pain in their efforts to bring inflation under control. "Inflation has declined, and we want it to continue to decline," Lagarde stated. "We're doing that not because we want to force a recession, but because we want price stability." The decision took economists and investors by surprise, as President Lagarde's recent speech had provided no clear signals regarding her intentions for this decision. Betting on a rate hike gained momentum in the weeks leading up to the decision, partly fueled by Dutch official Klaas Knot's warning that markets may have underestimated the likelihood of further action. The new economic forecasts presented by ECB staff on Thursday were a crucial factor in the decision. Lagarde commented that the economy is expected to remain subdued in the coming months, reflecting a period of slow and sluggish growth. This updated outlook predicts significantly slower annual economic expansion through 2025, with inflation expected to weaken, averaging 3.2% in 2024 and then 2.1% in the final year of the projection. Core inflation, which excludes volatile items like energy and food, has shown little movement and stood at 5.3% in August. Eurozone growth for the second quarter was revised downward, and business surveys indicated deteriorating prospects for the 20-nation bloc. The decision by the ECB is the first of several key central bank decisions across developed economies in the coming days. The Federal Reserve is set to meet next Wednesday, with policymakers there becoming more optimistic about their ability to address inflation without causing significant economic damage. Additionally, the Bank of England, the Swiss National Bank, and central banks in Sweden and Norway will announce their policy decisions a day later. ECB officials have recently embraced a message of prolonged monetary tightening, downplaying the likelihood of near-term rate cuts. Bundesbank President Joachim Nagel stated that it would be premature to speculate on rapid rate reductions. The decision to raise rates appears to have been a hard-fought one, with indications prior to the meeting suggesting that consensus building was critical. Hawkish officials, such as Nagel and Latvia's Martins Kazaks, expressed support for another rate hike, while dovish colleagues, like Italy's Ignazio Visco, cautioned against excessive tightening due to concerns about delayed effects. Bank of France Governor François Villeroy de Galhau emphasized the importance of the duration of interest rates rather than the specific level at which they settle.